We're here today to launch our May bi-monthly report focusing on trends and transactions in all sectors of the Irish commercial property market. Activity has gathered pace in the market over recent months following what had been a relatively slow start to the year. Investor demand remains strong and encouraged by the volume of activity in each of the various occupier markets, to the extent that we expect to see some price sharpening for prime investment properties in the Irish market over the coming months. However, investment spend is down year on year due to a relative shortage of product compared to the large volumes that have been traded in recent years. Indeed, approximately 492 million was invested in the Irish market during the first 3 months of 2017, compared to 735 million invested in the same period last year. Investors continue to focus on investment opportunities in the Dublin office market, encouraged by strong occupier activity and indeed the potential for additional demand materialising as a result of Brexit. However, considering the vast number of office schemes at various stages of the planning process, investors are undertaking detailed due diligence in order to fully understand the local market fundamentals and in turn underwrite their investment decisions. Considering the dearth of prime investment opportunities being offered for sale at present, there has been a shift in the dynamic to some extent, with an increasing number of investors now exploring funding opportunities as well as investment in alternative sectors. Now that new office supply is starting to be delivered and some buildings are being vacated as occupiers move to their new premises, availability has improved somewhat in the Dublin office market of late. As a result, occupiers are taking longer to make investment decisions. Nevertheless, office take-up is continuing at a healthy pace, with over 50,000 square metres let in the first quarter and a further 50,000 square metres reserved at the end of the first quarter. With several large transactions due to sign later in the year, the Dublin office market is on target for another healthy year of activity. Several Brexit-related mandates remain active, although the surprise election in the UK next month may now see some of these decisions being delayed somewhat. Nevertheless, Indigenous occupiers, who actually accounted for half of all leasing transactions signed in Dublin in Q1, and US occupiers remain very active. In any event, office take-up in Dublin will be heavily skewed towards the second half of the year, in our opinion. Rental values remain stable, but in provincial locations have increased over recent months, and it is encouraging to see planning applications now being lodged, and in fact in some cases construction commencing on much needed office schemes in the likes of Cork, Limerick, Galway and Shannon. Activity in the industrial sector of the market still remains constrained by a shortage of modern accommodation. However, there are signs of this being alleviated as some developers focus attention on preparing planning applications now that rental values are almost at a point where new industrial development is viable. Despite some negativity from certain quarters about the retail sector of late, activity from a property perspective remains strong. Core retail sales are buoyant year on year, footfall is healthy, and many retailers are reporting good levels of trading activity. Although some new occupiers are reluctant to make location decisions until after the UK election next month, and indeed fashion retailers are not expanding to any great degree, service industry tenants and those specialising in food and beverage and beauty remain active. Hotels have continued to perform well also over recent months, boosted in no small part by an increase in domestic tourism over the Easter period. Business has been particularly buoyant in Dublin, with RevPAR up 6.5% year on year in March, according to the latest STR Global figures. Trips to Ireland from the UK, however, decreased by almost 6% in the first 3 months of the year, which suggests that the weakness of sterling has started to impact on UK tourist volumes to Ireland, as had been anticipated following the Brexit referendum result last June. UK visitor numbers will therefore be monitored closely over the coming months as the official tourist season gathers pace. There were very few hotels formally launched for sale in the opening months of the year. Indeed, only 7 hotels with a combined value of approximately 26 million traded in the first quarter. However, this situation has now improved, with several larger hotels having been launched for sale in recent weeks, including the Knightsbridge Hotel in Trim, County Meath, which is guiding 18 million, and the Connemara Coast Hotel in Galway, which CBRE are bringing to the market, guiding €12 million. There's no doubt that the scarcity of housing in the Dublin market is the biggest issue facing the industry in the short to medium term. We are now urging government to step up their efforts in this respect, to abolish VAT on new home construction, and to facilitate the delivery of the build-to-rent concept, which has the ability to deliver scale in a quick fashion. We're also urging all landowners and stakeholders to release more land for sale to facilitate the delivery of much-needed housing stock. It is encouraging to see that activity in the Irish commercial property market has moved up a gear in recent months following what was a relatively slow start. A busy few months are now in prospect. To download our full May 2017 bi-monthly report, please visit the newsroom of our CBRE Ireland website at news.cbre.ie.